Well, we've had a real lack of investment in the electricity sector over the last 3 to 5 years because, in many ways, around the uncertainty here, but also the financial crisis. With the carbon tax that's proposed, it really doesn't give any long-term certainty as to what the economic rules of the game are going to be for a new investment. And these power stations are 30 to 50-year investments. So we don't know what the regime is going to be for an emissions trading scheme going forward. We know what the tax may be over a 3-year period, but we don't have long-term certainty there. So a tax really isn't going to encourage investment today. It's really just going to delay investment until the industry gets a much better perspective and view on what the eventual emissions trading
So do you believe there will be actually electricity shortages in, say, 5 years' time?
I think there's going to be real challenges during the peak times. We have a market where demand is very, very high over the summer months, and we came very close 2 years ago to having power outages here in Victoria. Of course, for the remaining 10 or 11 months, there's adequate supply, but it's those peak times that are really important. But we're not seeing a great deal of investment in whether it's a baseload supply or peak supply now because of this uncertainty.
So what's needed? I mean, do you need, instead of having a carbon price this year, July or August, that a target is set, is that what you need?
Well, the industry has actually been very supportive of an emissions trading regime, and lots of us within the industry operate in other jurisdictions that have an emissions trading regime. The issue for the industry is that the immediate costs of a carbon tax will be borne by the industry, and as a result of that, you see the equity value in the power stations being significantly eroded. Now, what that then leads to is the banks having real problems in lending to the industry, because suddenly they're lending to an industry where a lot of equity has really just been wiped away by the economic impact of the carbon tax. So we have a real freeze in investment. There's not a lot of attraction for equity investors coming into the market, and the banks don't want to continue to lend to those affected generators.
Well, I think I've said this to you before, but you're just talking your book, aren't you? I mean, or your company bought into an industry that had a bit of a horizon on it, that climate change was going to mean that generating electricity from brown coal was not going to be viable for very long. And don't your owners have to wear that?
Well, I think it's important to acknowledge that this is a country with 95% of generation here in Victoria comes from coal-fired generation, and over 80% across Australia. As an industry and as a company, we've been moving towards investment in new low-carbon and zero-carbon emission technology. A combined cycle power station we built in New South Wales has around 25% of the carbon emissions of a coal-fired power station here in Victoria, and we build a number of wind projects, and we're looking at solar projects as well. But because of the size of the coal-fired generation sector here, you can't change overnight. It takes time. It took us 50 or 60 years to build the power stations that are there today. We can't see this industry change the profile of its generation over a 5 to 8 year period between now and 2020. Over a 15-year period, for example, yes, I think we could see real deep inroads into replacing coal with gas and renewables. But doing it overnight is just impractical. So we're looking for a more measured approach to the replacement of that coal-fired generation with low-carbon emitting gas and renewables technology.
And we're in an interesting situation because a lot of the talk is around a carbon price of $20 to $25 per tonne, which it is generally agreed is not enough to convert coal generation to gas. Yet it is enough to make deep inroads into your profits. Isn't that correct?
Yeah, at the moment we have a carbon tax proposed that really isn't going to change much at all. At $20 a tonne, we don't see any change really between coal and gas-fired generation.
To what extent has the change in the political environment changed the dynamics of the debate that you're having with the government?
Well, first of all, there's not really a lot of clarity on what the long-term abatement target is. Yes, both sides of politics say 5%, but I don't think the Greens have adopted that target level. So we don't, as an industry, know to what target we're trying to lead over the next decade and beyond. Now, the second point is that in terms of transitional assistance, compensation, the Greens have indicated that they don't want to entertain that at all. Now, that runs the risk of leaving the industry with a number of stranded players who don't have any equity left in their assets, and therefore don't have the financial capacity to continue to invest in the industry. So the dynamic in the industry is probably worse than it was before the last CPRS. Now we've got a stakeholder there who really doesn't want to countenance any rational economic outcome with the industry, and that's a big concern.
And on the other side of the spectrum, you've got the coalition with a policy that involves writing you cheques to abate. Well, what do you think of their policy? Well,
the coalition's direct action policy hasn't been fleshed out as fully as I think it could be. But I think there is merit in looking at really a combination of the two areas here. We have no doubt, and there is no doubt, that an emissions trading scheme is the most economically cost-effective way over the long term of reducing the carbon intensity of an economy. In the short term, we've got 2 or 3 major emitters in this country, certainly here in Victoria, 2 or 3 large brown coal power stations that emit really a vast proportion of the carbon dioxide from the sector here. Now, I don't see anything wrong in dealing with the low-hanging fruit. So there are a couple of power stations there that if we addressed the emissions from those power stations, whether it's through a direct action or through some early closure negotiations, then that would actually get much more short-term abatement, and then that would allow us to progress into an emissions trading scheme which would allow us to, over time, really tighten up the carbon efficiency of the rest of the economy. Yeah, get the low-hanging fruit first.
Yeah, that's a way of... We've got one side of politics who got their policy. They won't countenance the other side, and the other side won't countenance the other side's policies.
So we're in a situation here where, as investors in the industry, we're in an impasse, and as a result, capital is not being invested. So we haven't seen new power stations built. We're seeing these impending shortages, and we're seeing electricity prices going up. Over the last 3 years, electricity prices have gone up by 40%, principally as a result of investment in networks. Over the next 3 years, we expect them to go up by about another 30%, and that's as a result of fuel costs going up, with gas prices moving up, and also...
And that's without a carbon price, right?
That's without a carbon price. A carbon price will add another $300 per household on top of that. So over a 6-year period, you're seeing an effective doubling of electricity prices for households with no tangible benefit. Now, I think if we can show to households and consumers that they're seeing abatement, they know what the target is, they can actually see some abatement through closure, that's more acceptable. But if you're not seeing any abatement, all you're seeing is a higher cost. That's not really a very saleable proposition.
Thanks for joining us, Richard McIndoe.
Thank you.